Welcome to Governance Minutes, brought to you by the Society of Corporate Secretaries and Governance Professionals, and Knowledge Partner host, Corporate Board Member, along with contributor Thomson Reuters.
Welcome. My name is Ken Bertsch, and we have with us today Naveen Reddy, who is the Director of Ratings at GMI Ratings. And to start, let's talk about GMI Ratings.
Well, GMI Ratings is the merger of three predecessor firms, GMI, which is Governance Metrics International, the Corporate Library, or otherwise known as TCL, and Audit Integrity. And the merger of these three firms brought three different products, essentially, under the roof of one company, which is now GMI Ratings.
Okay. So you've got different rating products, and they work differently, and I really wanted to focus in particular, I guess, on two. One is your Audit and Governance Risk Ratings, AGR, which I've been hearing about from some members who are new to it, although it's actually an old set of ratings, I believe. And then ESG ratings. And so could you talk about each of those and what they are?
Yeah, absolutely. The AGR is, as you said, Accounting and Governance Risk Rating. It's about 10 years old. It was developed by Audit Integrity, and its prime focus is on forensic accounting. And what we think about AGR is that forensic accounting is the predecessor, or it is what is needed to assess fundamentals in a given company. The AGR itself uses governance inputs, it uses a variety of accounting inputs as well as event inputs that we consider to be high risk. And those are all modeled statistically, taken from Thomson Reuters. We do a data poll, and that's all calculated by the model, and we do create a score off what is actually input. And the other model we have is the ESG model, which is environmental, social, and governance. And this is the product of Corporate Library and GMI Ratings merging together. And essentially, we've taken the best of both products. We had a really strong focus on materiality in the old GMI model, or the GMI model, the predecessor, and a focus also on environmental and social issues. The Corporate Library had a very good focus and very broad perspective on compensation issues. So we've taken that and integrated the best of both models and made it the ESG model, which we now provide to our subscribers.
Now, I mentioned to you earlier that I've heard from some members who are rated, their companies are rated highly in one and low in the other, and they're sort of asking why that is.
Yeah, they're essentially two different models. The overlap may be in some of the governance inputs when we talk about combined chair CEO, but that overlap is not that large. And the model that was developed for AGR was based on SEC fraud actions. That is the kind of target of what that model is trying to predict. Whereas the ESG model is really looking at sustainability risk, long-term sustainability risk. When we're looking at 3 to 5 years out, AGR is looking at 6 to 12 months out, which is the risk of some kind of financial statement or issue that may be occurring because of problems with reporting.
So a related question I hear is, how can I improve my ratings? And on the AGR side, it sounds difficult for the governance officer to do much.
Yeah, it is. I mean, it's not something that we have a tick box approach. It is, as I said, very statistical. It's mathematical. It's taking a large set of inputs that are primarily financial, but there are some governance inputs that do inform the model. So if someone is looking to say, well, my AGR is low today, what can I do tomorrow to make it better? Well, a lot of that is going to be driven by what we are finding in the accounting. So as a governance officer, someone who's looking at kind of more from a compliance perspective, a legal perspective, that's not something you can actually do actively in terms of changing the rating. Whereas on the ESG side, there is a materiality which we measure in terms of negative events, some positive events. And as well, there are disclosure items. So we do look at if a company has an overboarding policy, are they disclosing their voting results on time, those types of things where companies do have control. There are other factors like independence, which we do rate, which also the companies have control over
Sure.
as well. But,
Right. Okay.
yeah.
And how many companies globally, and how many in the U.S. in each of these ratings?
In the AGR side, we have about 18,000 companies rated globally. Roughly about 7,500 of those are in North America, and then everything else outside. And then in the ESG side, we have 6,000 companies. We moved from about 4,200 pre-merger to 5,500 earlier this year to about 6,000, which will have full coverage by June of 2013.
Okay.
Yeah.
And so who uses, particularly the AGR ratings?
AGR side is primarily used by our biggest client base for that product is the D&O insurance underwriters.
Okay.
And they use that product as an input to calculate D&O insurance premiums.
Okay.
It's a risk input.
Right.
They found that that's a product they actually lean on quite heavily to make assessments for D&O
Okay.
premiums.
Okay. And then I think you have a subset, or I may be putting this the wrong way, but it's a product that's really aimed at litigation risk. Can you talk about that a little bit?
Yeah, the litigation model, it's a separate model than AGR, but what it's meant to do is give some sense of the probability of litigation in the next the coming 12 months.
Right.
So
Okay.
it's looking at primarily class action litigation, the problems that arise with class action. And the inputs to that, we're looking at like maybe stock price drops and other elements that are common to firms that do have high levels of class action litigation.
Okay.
So again, that's something that the D&O insurance underwriters are looking at as something that they
Okay.
quantify.
So and how what is the predictability record? How good have these things been? Because the audit integrity was around for a while with something like this model.
Yeah, I mean it varies. I mean you look at the entire universe for the litigation model. Again, we're looking at probability. So if we look at a company and we say it has a 5% probability of litigation next 12 months, it's we think it's a 5%. I couldn't give you a hard number right now. I'd have to.
Okay. How about in terms of financial performance? I think what, and I also want to talk a little bit about, because you've partnered with an index based on AGR. Has there been correlation with investment performance?
Yeah, AGR, we did a recent study. It's a 10-year study, and we looked at North American companies that had $1 billion market cap or more. We rebalanced the portfolio every 3 months. We looked at the bottom decile of AGR rated companies, so it's the top bottom 10%, and then we looked at the top decile, which is the top 10%. And using those criteria, we looked at investment performance over a 10-year period, and we found that the top rated portfolio outperformed the bottom rated portfolio by about 1,000 basis points, or 10%, roughly over that time. We had about, I think on a yearly basis, it was on average like 2.8% outperformance. And it also outperformed the benchmark, which was the Russell 2000 over that 10-year period. Okay. Yeah. But
so that's fairly strong.
Fairly strong, yeah. The interesting thing too, we also did another study, kind of testing the black swan ability, I suppose, of what this means, and we looked at 70% plus drops for all those companies in that study, and we found that in the bottom decile, the likelihood of a 70% drop was 3.5 times more likely than the bottom decile. So the volatility is definitely higher.
So as we talked, I used to be at Morgan Stanley, and we had managers who use this as a risk management tool.
Yeah.
And so that would be part of it.
Absolutely.
Some ability to monitor both portfolio companies and screening companies that could go into the portfolio for risk.
Yeah, absolutely. I mean, it's definitely like a tool to, another tool in the toolkit to actually screen your stocks. And we think it's a way to really uncover issues that you might not find otherwise through just standard fundamental analysis.
Okay, as an investor.
Yeah, as an investor, yeah, absolutely.
Okay. And can you talk a little bit about this index and what that's about?
Yeah, we've partnered with Global Index Group, and the objective here is, what they're trying to do is create an index product based on the AGR rating, and the indices will be for asset managers, license out the indices, as well as a ETF product at some point in the future.
Okay.
So there's right now there's 6 indices that are built off the AGR, a high governance, a low governance, and then different select indices based on market capitalization. The indices haven't been formed yet in terms of out in the marketplace. They haven't been sold, but if you go to their web page, you can see the performance of the stock or the indices versus the benchmark over the past.
And you talked a little bit about your own studies on the audit product or accounting product. There's some people who've been critical of the checkbox, and even your comment implied some potential criticism of checkbox approach on governance. So David Larker of Stanford, for example, was pretty critical, although I think a little bit more positive on audit integrity, which is a different kind of product. Right. Can you comment on the effectiveness of governance indicators, including your ESG index, in flagging things for the longer term?
Yeah, the ESG index was really, or the ESG rating was really built on the fact that we wanted to identify companies at high risk. So it's a little harder to quantify investment performance versus kind of company failure. That's really what we're trying to identify, the risk of, again, a black swan event. So we'll take it back a little bit. In the predecessor firm, GMI, we had looked at a BP. And this is before the Macondo well blowout, and we were looking at materiality issues. And it was well known at the point they had a number of problems. They had a refinery in Texas, it was Texas City. They had a pipeline blow up, and we looked at those issues and we flagged them and said, these are issues you need to look at. And of course, roughly about a year later, we had the Macondo blowout, which caused, I think, the stock price to drop by 30 to 40%. We built that model to really, the ESG model, to really understand what are the inputs to these negative events occurring. So it's harder to quantify because on a year-to-year basis, performance may be great. You may be outperforming until that bad event happens. So.
Okay. And who's the market for the ESG product? Is it also D&O folks, or is it others?
D&O folks, though they are more in tune with the AGR product for reasons that are obvious, but we're looking at the investor market as well. We think there's validity in what we're doing in the investor side, that as anyone who has a portfolio, they should be looking at these risks because they present material risk to anyone that's holding a group of stocks in a portfolio.
Okay. So I think part of what's going on here is which some of our members maybe don't understand fully, is that the governance indicators alone, or even governance and some of the social indicators, may not be sufficient for a lot of folks. They're trying to look more holistically at the company, and they, to the extent that forensic accounting indicators are valid and have some predictive capability, it's really can be a very useful tool, I think, and that's why the D&O insurer interest, that's why you got a certain kind of investor interested on that side, right? Yeah,
absolutely, because it's not the checkbox approach as you had stated, and it's definitely coming from a different angle than what we've seen typical governance analysis can come from. So usually it's been policy disclosure, maybe independent supports. You look at shareholder rights, takeover defenses, those types of things, and we think those are absolutely important, but I think there's a whole realm of analysis and information out there that hasn't been really taken into account until recently. And again, we go back to materiality events. What is the board doing versus what they're actually saying? That's what we think is where this is all headed.
Okay. Well, great, Naveen. I think that's very helpful, and really appreciate your time.
Great.
Thank you.
Thank you very much.
Okay.
Join us again next time for Governance Minutes, brought to you by the Society of Corporate Secretaries and Governance Professionals, and Knowledge Partner host, Corporate Board Member, along with contributor Thomson Reuters.